Okay, hello everybody. Welcome to Karina Atlanta Mentorship. So before we get into the topic of the video, I did want to mention one thing. This is Velocity Banking College Graduate Edition, and it's very unlikely that the people who need to watch this video the most are going to watch it because YouTube keeps analytics and looking at my audience demographic. Very few people in that college age range, or actually 0% from 1824 watched this video, and 2.9% of people in the younger adult, mid-adult range watch this, and it's people who are over 35 who watch these velocity banking videos the most, right? So ironically, the people who probably need this video the most are most likely not going to watch it. But let's just do velocity banking anyways. Practice makes perfect, right? So let's just assume that we just graduated college with a $60,000 job. That's pretty sweet, right? Although nowadays, I don't know, may not be that high because of inflation, but I remember back in the day that if somebody had graduated college with a $50,000, $60,000 a year salary, I was like, man, that's pretty sweet. I kind of want that. And now, who knows if this is good or not? It's probably better to have at least a job versus no job, but that's about $4,000 a month, right? And so let's assume that we got into some debt. So credit card one, two, we have auto loan, we have two student loans, and it took me a long time to kind of figure out that student loans are actually for 10 years. I've always been writing them. They've been for 5 years, kind of like auto loans, I think. And to be honest, some of this information, I'm always kind of guessing because like I've never actually even taken an auto loan before. I drive a hand-me-down from a 2004 Camry, which runs pretty well. In fact, I went to the auto shop today to get an oil change, and the clerk complimented me. He was like, "Wow, you take care of your car really well." I was like, "Oh, thank you." Like, I didn't know how to respond to that because I'm not like a car enthusiast, and I don't. My car is kind of a mess, but he did compliment me. But okay, so back to my point. So let's say you graduated college, right, with all this debt, okay? So $65,000 in student loans, $20,000 in auto loans, $20,000 credit card debt. If you have only $900 of savings left over, that's not a good place to be if you graduate college and you're trying to look for your own place, right? So, there's a saying if you don't have the money, partner up with other people. So in this case, I just partner up with the parents, right? Mom or dad or whoever, and live with them and just don't pay rent, right? And just tell them, hey, um, listen, I got a lot of debt and college is expensive. And maybe you make the case like, hey, back in your day, you didn't have to pay that much to go to college and you got a sweet job. I get so much debt and I'm working my tail off, and I got a $6,000 job and the job market's crazy. So let me stay with you while I pay off my debt, and if you negotiate, you'll probably get what you want, right? So if you're sincere in your intentions and you're trying to pay off this debt, and who knows, maybe if you had went to community college, you wouldn't have to pay this nonsense, right? And you could actually get your own place. But the other thing too is that landlords won't rent to you if you don't make three times the income, um, or three times the rent in your income. So, for example, if I only make, and again, this is going to be a little bit off because I'm putting net here, but if I make 2,000, I'm sorry, if the place I want to rent is for $2,000 and I don't make $6,000 a month gross, they're not going to rent to me. That's just the standard for most landlords, right? So if you don't make enough money, guess what? You kind of have to focus on making more money too while you pay off your debt. And I think so many people don't think about both aspects because they have a limiting belief that they cannot make more money, right? So the prices of goods and services in general just kind of raise up, but you have to come with the belief, okay, if everything's going up, then my income can go up too, right? But a lot of people don't think that way. All right, so now we have our budget, and now we're going to do velocity banking. If you don't know what velocity banking is, all it is a really neat strategy where you can pay off debts using something called lines of credit, right? And we're going to make two assumptions, okay? We're going to assume that we're not going to make more income, although making more income is fantastic, right? You definitely should do that, but in this scenario, we're not going to. And we're not going to have any savings. So we're going to do this thing that will shock a lot of people. In fact, I even told my mom, like, I don't have any savings, right? And she was like, what? And I was like, no, 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 no. I put my entire paycheck into a line of credit. Again, it's a foreign concept with a lot of people. Okay? And what we're going to do is use lines of credit to pay off debts. And again, so Well, I'll show you how this works, and I'll show you how we can rearrange our finances to make this work, okay? So we have to have our budget, and then we have to have a line of credit as our main operating account. So what's the difference between the average American and the Velocity Banker? The average American pays things out of a checking account, whereas the Velocity Banker uses the line of credit as the main operating account. That's the only difference. Not about how much money you make, it's just how do you do your finances, okay? So now let's go ahead and do some rearrangement. And so what we're going to do is do this. We're going to calculate cash flow, which is C2 minus C3, okay? And again, it's going to be the same for now, right? The cash flow, but let's take a look at this. Let's assume that we have, okay, uh, hmm, a line of credit. Maybe we got it from a credit union for about 15% interest rate, and we'll say $15,000, okay? And now, this is going to highly depend on your personal situation because sometimes banks won't lend to you if you don't have a relationship with them. And what do you mean by relationship with them? Like a personal relationship? No, it usually means something like you have an account with them. So, for example, I try to get a business credit card from Chase, but then Chase rejected me saying, hey, one of the reasons why I won't lend to you is because you don't have any accounts with us, right? And they also looked at my personal credit profile. They have this rule. I think the 524. I don't know if you know it, but it's like a secret, kind of secret, hidden rule that the internet knows about. Where if you have 5 new credit cards open in the last 24 months, Chase doesn't want to like do business with you, right? So some banks have that. All right. So now, but let's just assume that we got a $15,000 line of credit. Okay. Now here's the thing. In general, with credit, there's a rule that it's not like a hard and fast rule, but there's a rule that says like, and I didn't come up with it. Banks will only lend you money when you don't need it, right? So it's very unlikely that you're going to get this line of credit at this time, but we're going to make the assumption that we got it before we did all this nonsense, right? And the way that I know this is because I'm getting so much credit right now, and I don't need it. In fact, I have about $249,000 in lines of credit available to me, and I can do sky's the limit with that. But the reason why banks are lending me that is because I don't need it right now. Now, if I did it when I was broke and poor, guess what? They're not going to lend it to me. And you might be like, that's not fair, right? That is unfair, or it seems like it's unfair. But guess what? If they lend to you when you do need it, they're going to be broke, right? And if you look at the Apple Card with Goldman Sachs, type it in Google, and actually I could just do this right now. Goldman Sachs Apple Card. We should have never done this, right? So, if you don't know about the Apple Card, this is something started by like Goldman Sachs. They partnered up with Apple, and they said this was an effing mistake, right? And that's what happens if you don't do lending properly, and they're going to go broke. And that as a lender, the only way you can make money is if people are paying you interest. And so if you just lend to any old thing, then guess what? You as a bank or a lending company are going to go broke. And because Goldman Sachs doesn't have the experience in consumer lending, I think this is like the first time they ever did consumer lending products. That's why they effed up, right? And so you could kind of look into more into that. But my point is that certain things that you perceive as unfair is actually the right thing for the bank to do, even though you may not realize it at the time. Okay. All right. So let's go ahead and do this. Let me close this window out and let's, do some transfers. Okay. So let's free up cash flow. So here's the thing. I have a 5% credit card at 30%. So I definitely want to move that. Okay. So let's go ahead and move that here, $5,000. And then once I just do that debt transfer, what happens? This is zero. Bam. Right. Another thing I can do is I can move this 15,000 parts of it into this line of credit, right? Now I know this is like only a 1% difference, but maybe that 1% difference, even though it's minute, well let's get rid of the 30% credit card. Okay, so now let's move 10,000 here. So this is going to be 15,000. Okay, so this is going to be 15,000 balance. And now what we got to do is this is going to be 10,000. So I'm sorry, not 10,000, 5K, right? And now we got to recalculate this minimum monthly payment. So let's go ahead and just use a calculator from Bankrate. So Bankrate min monthly calculator credit card. Okay. And this is what I use to kind of calculate the minimum monthly payments, although each bank is pretty much different when it comes to how they calculate the monthly payment, but this is just an estimate. So this is going to be a $5,000 balance at 29%. Okay, let's go ahead and do that. So 29%, and that'll be 170.83. Okay, awesome. Okay. Now take a look at this. We increased our cash flow without really just doing anything, just doing a simple debt transfer. So here's the strategy, right? You put your entire paycheck into the line of credit, and that satisfies the minimum monthly payment, and then you take your expenses out, and then you do it over and over again, and so your balance of the line of credit is going to go down by your cash flow plus the interest, okay? So let's go ahead and just do some formulas. These formulas are all the same in every single video that I do. So what we're going to do is take the previous month's balance and interest, minus it by the cash flow, okay? And we're going to just do a formula for the month. And so how do we calculate the interest? What we're going to do is we're going to take the average of these two numbers. This is just an estimate, but the banks calculate the interest by the average daily balance, and then we multiply by the interest rate, 15%, right? And then you divide by 12 because it's calculated monthly, right? So the APR, annual percentage rate, applies to the whole year, whereas if you want the monthly interest, you got to divide by 12, okay? Now in month 0, we're assuming that like we're not, this is the first time we're doing it, okay? But, when month 1 happens, that's when the first statement comes out, and that's when the interest starts to get calculated, all right? So now what we got to do, so here's the thing, right? When it comes to credit cards, the payment is not fixed, right? So in an amortized loan, payments are fixed to the death of the loan, right? Like at the very last payment, it's still going to be like 386, 414, 111, 12, right? So just be aware there's going to be a little bit of inaccuracy because the payment's going to go down after every single month, and you could kind of see that right here if you go to the payment schedule. We'll go ahead and calculate that. And so the first minimum payment is 170.83, and then it just goes down, 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 little by little, right? So just be aware of that. So there's a little bit of inaccuracy, but we'll just assume that the payment stays the same. All right. So now let's go ahead and kill this sucker off, right? And so it's going to take us about 12 months to entirely wipe out that. Well, actually, we can do this, right? So let me just assume. So if this is 5K, we could put another 5K-ish around here. So let's go ahead and do that and kill off the entire credit card balances and then recover our entire cash flow, okay? And then so at this point, right, so let me go ahead and highlight this. And it's yellow because this is, I just want to highlight when we move some of our debt. And when we move this $5,000, and it's not going to be $5,000 at this point, but I don't want to do the, be too accurate, do the math. It's more important to get the concept. Guess what? This is going to be 0. And now our cash flow is actually 1587.77, right? We increased it, okay, just by doing a simple debt transfer. Okay, so now let's go ahead and do this and figure out when it's going to be paid off. So it's going to be paid off in 14 months, all right? We'll say 15. I know we have this little itty 20-something dollars. I don't know. Like I would actually, consider this to be the payoff date just because it's so low. But if we want to be super accurate, maybe we'll do 15. Always like to overestimate a few things, and they say that the key to happiness is like low expectations, right? So now what we're gonna do is we need to write down our milestones, right? So every time we estimate our debt payoff, it's gonna be, so we just say, okay, 15 months to pay off 20K of debt. So 15 months, 20K of debt, right? So these two is the 20K. All right, so next we got to figure out what do we tackle? The auto loan or 2 student loans? I actually went into Navy.com to look at my paid off student loans, and I didn't even remember that student loans were amortized for 10 years, right? Like it says in the website, interest rate set by government, and this is a 10-year loan. I was like, oh shoot, I forgot. And so I was always, every single Velocity banking video, I've always assumed they're 5 years, but it kind of makes sense that they're 10 years. And the funny part is that a lot of people can't afford their payments, which is why they do like the income based repayment programs. And then if you ever do the income based repayment programs, the interest just keeps growing on the loans, right? And so there's something called like the student loan debt bomb or something like that. But let me actually look it up. Income based repayment debt bomb, right? And so what happens, if you didn't know, is that if they ever forgive your student loan, again, don't take this at my word. Talk to an accountant about this because I'm not an accountant and I'm not giving you financial advice. My understanding is if the IRS ever forgives like a student loan or some kind of a loan, they count it as income. So, for example, let's say I had $200,000 in student loans, and then it gets forgiven by like maybe a government program. Again, I don't know if this is totally accurate because I'm not an accountant. When it's forgiven, that $200,000 is counted as income. And so they're going to tax you as if you made $200,000. Isn't that insane? And so that's why they talk about student loan tax bomb, right? So that's why it's best to never touch these things at all. Go to a community college or not even, you know, go to college and learn how to build a business that creates you income without getting yourself into toxic debt. Because I heard this that well, let me restate this. I heard that student loans are like the number one asset for the federal government, right? Because if you got $1 trillion of debt and it can't be forgiven because that's how the laws are written, that's really insane. And so there, it's going to be till death do you part, and even that might not even happen because I don't. I think I read somewhere that it has to be paid by your heirs or something, or maybe not, or maybe I'm just thinking worst case scenario. I don't know. Okay, so back to my point. Now we have to figure out. All right, well, what am I going to focus on? The student loan, the auto loan, or the um, well, which student loan? Because sometimes they're broken up into multiple loans. Because, for example, when I got my student loans, I had like three of them. So, which ones are we going to focus on paying off? Okay. And actually, let me write down the objective. So, what we're going to do is figure out five. So, what I'm going to do is total up all the loans. So, 5 plus 15 plus 20 plus 45 plus 10. And you'll see that's 95,000, right? So, if you sum up all the balances, so the objective will be pay off 95K of debt, which is kind of a lot, isn't it? Especially for a college grad. No wonder you can't get an apartment. You gotta live with mom and dad. All right, so now let's go to here. So figure out which of these three we want to pay off. So there's two types of criteria you could use. This is like the general payoff criteria. So the lowest balance, highest interest rate, and highest payment. You want to look for loans that fit into these categories, or you could use something called the cash flow index, which ignores the interest rate. So if you don't know what the cash flow index is, let me just kind of calculate it for you. All it is a formula that takes the ratio of the balance of the loan compared to the payment. And if you ever look up Garrett Gunderson, the Wealth Factory Cash Flow Index, they have an explanation of what that means. So let me just take it for these three numbers. So 20. Actually, let's do this. Let's figure out what these loan balances are after 15 months. We got to do that first to make it more accurate. So let's go ahead and look up these amortization um, calculators. So 20,000 at 6%. And after how many months? It's 15. 15. So it's now 15.5 grand. All right. All right. And then for the student loan, this is going to be 45K at 4.5%. 45K at 10 years at 4.5%. And then at month 15, it's going to be 40,000, right? So some of it is chipped away as we're making payments. And then let's do 10K at 6%. So 10000 at 6%. Okay, and then that'll be the 15th month. So that now it's going to be 9K. 9K. All right. So now let's go ahead and calculate the cash flow index. So what we're going to do is take that payment, so equals 15546.35, or balance divided by the payment, which is 386.66. This one is I'm sorry, 40, I'm going crazy, 40416.54 divided by 414.55. This one is 9051.95 divided by 111.02. Okay? So according to this, I should pay off the auto loan first. And the reason why that is that think about this. If I pay 15 grand, I get $386 back. But if I pay off 40 grand, I only get about $400. So it's not that much. So it's like you get more bang for your buck. So you could kind of think of this as a ranking system that you want to pay off the lowest one first. And in Garrett Gunderson's website, he says that anything below 50 is considered a quote an inefficient loan, meaning too much payment compared to the balance, whereas anything above 100 or above 50, I think, and then especially above 100 is considered to be efficient, meaning that your the payment of the loan is way too small compared to the balance. That's all that means. But let's go ahead and see if we can actually pay this sucker off. So let me just do this. So with this 6% loan, okay, we can pay this off. So let's go ahead and actually try to do that in its entirety. So what if I put in, so at this stage, maybe just $546? So let's see this, 546.35. Okay, whoopsie. 6.35. All right, and then now we're going to put in the entire 15 grand at the next one. Again, this might be a little bit inaccurate, but I'm just guessing. Is it going to be less than 14? Yes. Okay, now at this stage, so let me put this here, highlight these, because this is when I transferred this auto loan debt to the line of credit. All right, so now what we're going to do is redo our cash flow number. And what is this? Now look at this, 1974.43. Okay, so 1974.43, and now we gotta redo our cash flow number. Okay, so 1974.43, and now I just gotta copy and paste this. Okay, and actually, let's see. All right, so at 23 months, we've paid off this auto loan. So 23 months. Now we paid off how much in debt? 40K of debt. Okay, so it only took us about 8 more months to pay off that auto loan, right? And then now we have to figure out what the new cash flow index is at at this for these two loans. So now it's we're going to be look for the 23rd mark. So the 23rd month. So 10,006. So 23rd is 8 grand. So now it's 8 grand. Okay, and then now for loan number 1. All right, so loan number 1, which is 45K at 4.5%, 45,000 at 4.5%, and 23. Do we just say 23? Sometimes I just say it and then I forget it right after I do it. So 23 months. What's the balance? So it's going to be 37K. So 37K. Okay. So now let's just recalculate that cash flow index. So usually with the credit cards, the cash flow index never changes, but the amortized loans they do, because the payment's always the same with the amortized loan, which the credit card's not. So 37864.75. Okay, and then this one is 8516.57. Okay, so now this is in the 70s. So this is what we can do, right? So I'm going to pay this one off first because of the higher interest rate and the lower balance. So Yes, it does fit that cash flow index model where it's like the lower one, but I'm also interested in this one too because it has the lowest balance, the highest interest rate, not the highest payment, but it has a lower cash flow index. So I'm kind of using both criteria to figure out which one I want to pay off. Now, one of the things I can do if I'm a little bit more semi-conscious of this cash flow index not being below 50 is that I could just do quote chunking, and chunking is really resilient to like interest rates. Like so, what does that mean? Is just take your income amount, like 4,000, and then move it to the line of credit, and then just keep paying off until it goes to zero. You can certainly do that, and we actually have a velocity banking calculator that will actually do that for us from Renatus, and I'm a Renatus student. So if you're a Renatus student, you have access to this calculator, and I actually sell their products, believe it or not, because I'm an independent contracted marketer and try to build educational communities who learn about this stuff. Uh, and so, if you ever roll in their educational courses, you'll have access to this program, or at least the essentials course. Okay, so now let's just do this. Let's just write down. So I'm just going to do this. A516.57. So 8516.57. And I'm going to put in the original balance. So this is going to be 10K 10000. Okay. And what's the interest rate? The interest rate is 6%, and it's going to be a 10-year term, and the payment amount is 111.02. 111.02. Now, if we just move little pieces to our line of credit, we'll just do the income amount, which is 4000. The line of credit interest rate, we'll say is 15%. And then the monthly income, how much is our monthly income? 4 grand, right? And our living expenses, let's take a look at that, is everything except the loans, right? So 1500 plus 414, so 1914.55. 1914.55. Okay. And so now we see that it actually takes us zero point 0.4 years. Isn't that crazy? 0 0.4 years. What's 0.4 divided by 12? Or 44, 0.4 times 12. I think that's how we figure how many months it is. Well, let's just do that. So let me just do this equals 0.4 divided by 12. So that's 4.8 months. Okay. So this student loan here, so the new milestone is 27.8 months, and we'll include that now. It's the 50K, right? And so at 27, well, we'll just call it 28 months, just to round up, make it easier. At 28 months, we'll have paid off 50K, and now we can use our velocity banking cheat sheet calculator just to figure out how long it'll take us to pay off the student loan. But once this is paid off, guess what? Bam! Now our cash flow is 2085. All right. So now let's go ahead and do this one. So we got to figure out the balances at 28 months. All right. So 28 months, it'll be 36K. Okay. So all right, so now let's go ahead and write this down into our cheat sheet calculator, right? And this is going to be 45 grand at 4.5% interest rate, and we'll just put in our monthly payment, which is 414.55, right? And we're just going to put in the same information. The only thing that changed is our expenses. So all we have to do, because we just include everything except for the loan we're paying off, is 1,500. Okay, 1,500. And then this one is going to take off 1.3 years to pay off, right? 1.3 years. So now, 28 months. So let's figure out what 1.5 years times 12 is. 5 times 12. All right, so now let's go ahead and do that. And that's about 18 months, right? That sounds right. Okay, so now this one here is 18 plus 28. So that was that 56. So plus 28. No, that's 46. And then what's 46 divided by 12. I'm sorry, 46. That's 3.83 years. So the final payoff is going to take 3.83 years for 95K, right? So after you graduate college, it's going to take you less than 4 years to pay this off. And so now it's our real cash flow is going to be 2,500 a month, which is pretty good, right? Now you'll be able to afford your own apartment. You don't have to live with mom and dad, and you probably even afford a house. I mean, if you have this much cash flow, it's pretty good, right? Don't don't get a payment that's worth up to 2,500 because you know that's a huge house here in Georgia. But I know people here who overpaid for a house and now regret it because they lost a job or they changed careers, which paid significantly less. So again, everything with debt is risk, right? So it's risk for you because if you something about your circumstances changes, then and let's say you do get a mortgage, that's about like $1,000, or I'm sorry, not 1,000, $2,500. I don't think the bank will let you have that. But if you do, then you lose your job, you're screwed, right? And you're zero cash flow. Okay. All right, so now, yeah, that's pretty much it. So we paid off all of our debt in 3.8 3 years. So now let's focus on increasing our income. Hey, if we live with our parents and our rent is zero, that's fantastic because maybe we can use this cash flow to help us expand our wealth, grow our business, buy some apartments rather than buying our own home, right? I don't know if you ever read the book Rich Dad Poor Dad, but one of the things it talks about is how your personal home isn't an asset, it's a liability because it's taking away money from your pocket then rather than giving money in your pocket, right? That's the difference between income. I'm sorry, an asset versus liability. All right, well, that's it for today. This is Korean Atlanta Mentorship. If you're interested in joining our group, go ahead and click the Google form link below. Other than that, have a great day. Hopefully, you're an actual college student who actually thinks this is useful, and you might find that this actually came at the right time for you. I actually meet so many people who are older, and they're like, "Oh, I wish I learned this back when I was in college." But hindsight's 2020 because the people who are in college now, as you saw from the YouTube statistics, are the least likely to watch this video. All right. Anyways, have a great day, everybody, and we'll speak next time.